In 1971, the United States ended the gold standard, leaving the dollar unbacked. Many economists predicted the dollar would collapse without physical gold to support it. But instead, the U.S. dollar remained the world's primary reserve currency. The key to this survival was a strategic alliance known as the petrodollar system. Today, we're going to look at the history of how oil became the new backing for the global financial system. To understand the petrodollar, we have to look back to the early 1970s. The U.S. economy was facing severe inflation and a trade deficit. At the same time, the Organization of the Petroleum Exporting Countries had raised oil prices. This created a massive transfer of wealth to oil-producing nations. In response, President Richard Nixon sent his administration to negotiate a deal with Saudi Arabia. The agreement, finalized in 1974, was simple but incredibly powerful. The United States agreed to provide military protection and weapons to Saudi Arabia. In exchange, Saudi Arabia agreed to price all of its oil exports exclusively in U.S. dollars. They also agreed to invest their surplus oil revenues back into U.S. government debt. Because Saudi Arabia was the largest oil exporter, this set a precedent for the entire world. Soon, every other OPEC nation followed suit, pricing their oil only in dollars. This meant that any country wanting to buy oil had to first acquire U.S. dollars. Whether it was Germany, Japan, or Brazil, every industrialized nation needed a massive reserve of dollars. This created a constant, artificial global demand for the U.S. currency. It allowed the United States to run large deficits and print money without facing immediate hyperinflation. The petrodollar system effectively replaced the gold standard with an oil standard. For decades, this system anchored the dollar's position as the global currency of trade. The surplus dollars held by oil-producing nations, known as petrodollars, flowed back into Wall Street. This massive influx of capital funded American banks and lowered borrowing costs for consumers. But this system also tied U.S. foreign policy deeply to the stability of the Middle East. Any threat to the pricing of oil in dollars was seen as a direct threat to U.S. national security. When nations like Iraq or Libya suggested trading oil in other currencies, it led to severe conflict. Today, the petrodollar system is facing its first major challenge in 50 years. Major powers like China and Russia are actively working to bypass the dollar in trade. China has introduced the petro-yuan, allowing oil purchases in Chinese currency. Saudi Arabia has also expressed openness to trading oil in currencies other than the dollar. A decline in the petrodollar system would reduce the global demand for the dollar. This could lead to higher inflation in the United States and rising interest rates. The transition away from the dollar and oil trade is part of a broader shift toward a multipolar world. While the dollar remains dominant, the absolute monopoly of the petrodollar is eroding. Understanding this history shows how energy and currency are intimately linked. The stability of the dollar has always depended on its utility in global trade. For investors, monitoring these shifts is crucial for long-term wealth preservation. Productive assets and commodities like gold remain important hedges against currency changes. The rules of global finance are shifting, and the oil standard is no longer absolute. Diversifying your holdings is the key to navigating a changing global system. Keep your portfolio resilient by aligning with real-world energy assets. The geopolitics of currency will continue to be a major theme in the next decade. Stay informed on international trade agreements to protect your financial future. In the next years, global currency alliances will continue to evolve. Adapt your investment strategy to reflect the changing role of the dollar. The petrodollar era built the modern financial world we know today. But those who adapt early to the new multipolar system will be best protected. Focus on acquiring hard assets that maintain value independent of currency shifts. Separate short-term market noise from long-term macro